Let's talk a little bit about stockholders' equity by working exercise 3. Now, when we go into exercise 3, we're actually looking at reacquiring shares. Companies reacquire shares either to hold as treasury, which reduces our stockholders' equity, and that can be resold in the future, or they retire those shares, which takes them from an issued status all the way back to an authorized but unissued status. So in this first problem, what we're going to look at is taking it or retiring the shares, taking it back to an unissued state. And then in a later exercise, we'll look at treasury shares. Now, first and foremost, you need to have your video exercises up. We're going to look at exercise 3 on that handout. If you're not in one of my classes and you're watching this, then you just need to copy down the information so you can work along. So let's look at this problem. First off, let's get the information here. Warner Communications Articles of Incorporation authorized the issuance of 140 million common shares. The transactions described below affect changes in Warner's outstanding shares. Prior to the transaction, Warner shareholders' equity included the following: common stock, 125 million shares at $1 par, 125 million in that account. Remember, we must carry common stock at par. So since we issued 125 million shares and we have a $1 par, that means the balance in that common stock account would be 125 million. Then we've got paid in capital in excess of par, and I call that PISIP. So when I say PISIP, I'm talking about that paid in capital in excess of par account. Has 375 million. Remember, PISIP is the amount above par that is paid into our company. So usually if you take the par plus the PISIP, so if you take the common stock account plus the PISIP, that was the market value on the day of issuance in theory, the amount we actually were able to sell our stock for. And then finally, we've got our retained earnings, 235 million. And again, retained earnings is the amount we've earned that we've kept in the company that we have not allocated out in the form of dividends. Now, assuming that Warner Communications retires shares it reacquires, so we're going to look at retirement first, which means they restore their status to that of authorized but unissued shares. Record the appropriate journal entries for each of the following transactions. Okay, January 7th, Warner reacquired 2 million shares for $7.50. August 23rd, Warner reacquired 4 million shares at $3 per share. And then finally, on July 25th of 2019, Warner sold 3 million common shares at $9. In other words, they issued those retired shares back out in theory, even though we don't know if it's the same shares, but they did then issue stock. So let's look at this step by step. Now, in order to do this, you do need a journal page. So make sure you set up a template for your journal. You'll need our dates in there and a general format. And this is just a general journal, just so we can see how they're recorded. Remember, companies use multiple journals, but this is just to give us an idea of how these would be recorded or how they would impact us really at the end of the day in our books. So January 7th, we got our date, our general journal or our account, then debit or credit. All right, so now moving into this. We're going to move into this problem. We're going to look at this January 7th transaction. We're going to really get a feel for what would we journal. So let's look at that next little bit of information and see what do we need to do. So January 7th, we reacquired 2 million shares at $7.50. Well, when you go to retire shares of stock, it makes them unissued shares. So in other words, anytime we issue the common stock, we credit the common stock and we credit the PISIP account, paid in capital in excess of par. So when we go to retire those shares, we basically have to reverse that entry. In other words, we have to remove the common stock. So we're going to debit the common stock, and we have to remove any paid in capital that common stock may have put into that account to begin with. So that's the two pieces. So let's start with the common stock piece. What do we need to do there? Well, we're doing 2 million shares. And we're doing those 2 million shares at $1 par. So when we remove those 2 million shares from the books, we need to debit our common stock for that $2 million. So that's step one. We're going to debit common stock to remove the common stock from our books. And we're going to hit that for $2 because we carry common stock at par. So we have to remove that at par. So now, what's the next piece of that? Well, when we go into the next piece of that, now we need to look at how much would we take out of our paid in capital. So let's glance there and just sort of figure out how much that would be. So when we look at this, we've got to check our paid in capital. Notice it has a balance of 375. Well, how much of that needs to come out? Well, 375 divided by 125. So that's going to tell us basically how much to go in there. So look up here to figure this out. We're going to hit paid in capital in excess of par. That's going to be our account. How much? Well, let's look and see. Up here in the right-hand corner, we've got 375 divided by 125. That means $3 per share. So our common stock initially, on average, put $3 into the PISIP account. So we need to back those $3 out. So we're going to hit our paid in capital in excess of par, or PISIP account for common stock, as I like to call it, PISIP. We're going to take that $3 per share times $2 million. So we're actually going to hit that account for $6, okay? That's what it put in the account to start with on average. So that's what we have to back out. Now, the next piece of this, really, let's look at the cash piece, because I said we need to reverse the issuance. So we're assuming we issue these for cash because we're buying them back for cash. So that's just going to be our assumption. So basically, we're reversing our issuance. So remember, when you issue shares for cash, you debit cash, you credit common stock, and you credit paid in capital. So now we're reversing that. We're debiting common stock, we're debiting paid in capital. So that means we need to credit cash. Well, how much cash do we need to credit for? Well, we've got 2 million shares and we paid $750. So what we need to do is take that 750 times 2. So right there, you should see in the middle of our screen, we've done the calculation. That gives us 15 million. So now we actually know how much cash we spent on this. So we need to hit our cash account or reduce our cash by 15 million. Now, how do we do that? Well, to reduce cash, guess what? We're going to go in and we're going to credit our cash. So we're going to credit cash for that 15. Now, obviously, we're not balanced. So what's the deal here? Well, when we're reacquiring to retire, we've got two possible situations. Well, three, really, if you think about it. One, we can pay more than the original owner paid for the stock when we repurchase it. We can pay the exact same as the original purchase shares, or we can pay less than the purchase shares. So in this case, if you really consider it, on average, our shareholders paid $8 a share for our stock. We're buying those shares back at 15. So we're paying more. When that happens, that additional money we pay, we consider that an allocation of our retained earnings. In other words, we're going to reduce our retained earnings by that amount. So we're going to debit retained earnings for 7. If we paid the same amount, we would not have to worry about that because our entry would have been balanced when we hit the cash. Now, what happens if we pay less than the original? Well, in that case, we basically call it additional paid in capital for our shares repurchased. And we'll look at that. Be careful in problem 2 here, or part 2 on what's the date? August 23rd, because that's exactly what happens. So in this, basically, look, we reversed our issuance. We debit common stock, debit paid in capital, and credit cash. If there's a difference between what our original owners put in and the cash we paid out, then it either hits retained earnings or paid in capital. If we pay more, it's going to hit retained earnings, okay? So sort of, it's not a dividend, but think of it that way. Basically, since we're paying them more than they paid us originally, we're really giving them some of the earnings. We're allocating some of the earnings back to this owner that we just bought the shares back from. All right, so now what's going on here? Well, here's the full little bit of information. I want you to pause this video and I want you to work August 23rd and July 25th and see what you come up with. And then once you've worked through those two, then come back and I'm going to quickly go over the solution for those two. All right, now that you've had a time to pause this video and watch those two, let's go in and see what would be this answer. How would I work these two problems? Well, to look at August 23rd, the same exact concept applies. We're going to debit our common stock. Notice we reacquired 4 million shares, so we're going to debit it for $4 million, or 4 if we drop the 0, because it's carried at par. So we have to remove those shares, 4 million shares from our book, by taking the 4 times the $1 par. Now, again, we already knew that paid in capital in excess of par, our PISIP account would get hit for $3 per share. So $3 per share times 4 million shares gives us $12. So we're backing out the original impact. We debit common stock for 4 par value. We debit the paid in capital, the PISIP account, for 12, the amount on average that it originally contributed to our paid in capital. Now, our cash. Our cash is $3. Notice that's lower than what the investor originally paid. So our cash is coming out at 12. So since we paid less, then what our owners originally contributed, we consider that paid in capital shares repurchased. Really, we're reclassing it from PISIP account into PIC for shares repurchased, paid in capital for shares repurchased. So it stays in stockholders' equity. It just shows that we're not allocating earnings. We're actually sort of still getting more money, I guess, in theory, because we paid less than our owners originally put into the accounts. Okay, so we're going to credit our paid in capital. And that happens anytime you pay less than the original average investment in our company. We actually move that PISIP into paid in capital for shares repurchased. All right, so what did you do for that last problem? And on that very last problem was simply an issuance. These aren't treasury shares. We didn't buy any stock back for treasury. We bought them back to retire, so it's as if they were never issued. So on the 25th, when we go to sell more shares, it's basically just a new issuance. So we're going to debit cash for the amount we received. So you should have taken 3 million shares times 9. So you receive cash of 27. We're ignoring issue costs here. We would hit our common stock for 3 million and we have to carry it at par. So we're going to do 3 times 1. So that's going to give us our 3. And then, of course, our difference goes into PISIP, which is 27. Okay, so that's sort of a neat little calculation, or excuse me, 27. I said 27. I'm sorry, 24. So paid in capital is 24. I was looking at the wrong line, which again is the difference between our market value of $9 per share and our par value at $1 per share. So that's $8 per share times 3 million shares, or 24 million in total. All right. So I hope this sort of helps you see how would I journalize transactions where I actually go in and retire the shares of stock that I've repurchased. And they're not bad entries. Just remember, you're basically reversing the issuance. And once you get that in your mind and figure out exactly what you're reversing, it helps a lot. All right. I hope you've enjoyed this video, and I hope you understand a little bit more how to journal retirement of shares.